let's get right to it. Welcome to Iron Financial. Tonight, we are putting RPM International under the microscope. The stock just popped, almost 9% after hours? And you know the headlines are screaming record sales, record adjusted profits. But you know us. We see a headline like that and we ask one simple question. Is this real strength, or is the market just getting high on paint fumes? We're going to forge through the noise, stress test these numbers, and find out if this company is truly built to last, or if it's all just a flip.
Whoa, hold on there. Lead analyst is right, but that one word, adjusted, that's my cue. Every single time I hear adjusted earnings, my alarm bells go off. See, the market falls in love with a shiny new skyscraper, right? But my job is to go into the basement with a flashlight and check for cracks in the foundation. Is this thing built on solid concrete, or are we looking at some particle board with a really nice coat of paint? That 9% pop looks fantastic from the outside, but we need to know what's actually holding it up. Let's find out.
Exactly right. And that's the mission here tonight. We're not just reading the press release, we're putting this entire company through a gauntlet. We are going to stress test RPM from its foundation all the way to its roof. We're going to start with the bedrock, its dividend. Then we'll tear into the growth engine piece by piece. We will absolutely scrutinize the debt load this thing is carrying. And then we'll take a hard look at the leadership, the foreman on this job site. Only after we've checked every single load-bearing wall will we deliver the Iron Financial verdict. And that's the blueprint. We're going step by step to get to the truth here. We're not cutting corners. We're not glossing over any ugly details. If there are hairline fractures, if there are any cracks in this company's armor, you better believe we are going to find them. So let's get to work.
Okay, let's kick things off with the bull case. And for a company like RPM, that story always begins with the dividend. Now look, this isn't just some nice little feature for them. For their long-term investors, this is the absolute bedrock of the investment. In a market that is just obsessed with flashy high-growth tech stories that come and go, RPM has built its entire reputation on a foundation of something else: consistent, reliable, cold, hard cash returned directly to shareholders. It is the cornerstone of their value proposition, and you could argue it's the most solid part of the entire structure.
And this is the number that backs it all up. 52 consecutive years of increasing their cash dividend. Just let that sink in for a second. We're not just talking about them paying a dividend. We're talking about giving their investors a pay raise every single year for more than a half a century. Think about what's happened in that time. Recessions, market crashes, global pandemics, you name it. This puts RPM into a super elite club of companies, the so-called dividend kings. Out of the thousands of companies you can buy, only a tiny handful can claim a longer streak. This isn't just a track record, folks. It's an ironclad commitment to shareholders.
Okay, you're not wrong. 52 years is impressive. It's a long, sturdy history, I'll give you that. You can see right here, they kicked this whole thing off way back in '73. Sales were just a tiny $25 million then. Now, they're pulling in over $7.4 billion. It's a heck of a growth story. But my job is to look forward, not backward. Is that history a guarantee of future stability, or is it a heavy legacy they feel they have to live up to no matter the cost? You know the saying, past performance doesn't predict future results. And that's especially true when you see the whole company's strategy shifting so hard toward aggressive, debt-fueled acquisitions. Is the original blueprint that built this house even relevant anymore?
But you can't argue with what that legacy has delivered. $3.9 billion. That is the amount of real, actual cash that RPM has handed back to its shareholders in the form of dividends over that 52-year run. Now think about that. This isn't some theoretical stock value or some fleeting paper gain that depends on the market's mood. It's real capital returned directly to the owners of the business, year after year after year. That builds a level of trust and a shareholder base that is incredibly strong and incredibly loyal. So this dividend isn't just a number, it is a fortress. But, even the strongest fortress needs a thriving kingdom inside its walls to keep it going.
That's the perfect way to put it. A dividend fortress means nothing if the economy inside is crumbling to dust. You absolutely need a powerful growth engine to keep those coffers full and to keep that dividend check getting bigger every year. And if you just look at the surface, RPM's engine looks like it's firing on all cylinders. They just reported record third-quarter sales of $1.61 billion. That's up almost 9% from last year. That's the big, flashy number that crushed expectations and sent the stock surging. So now it's our job to pop the hood and see which parts of this engine are actually doing the heavy lifting, and which ones might be leaking oil.
Okay, let's break this thing down. Let's look at where the power is coming from. Take a look at that top row, the Construction Products Group, or CPG.
Sales are up a really strong 10.5%. But that's not the real story. The number that should make any investor sit up and pay attention is the adjusted EBIT growth, a jaw-dropping 178.8%. I mean, that is just incredible operating leverage. For every new dollar in sales they're bringing in, their profits are absolutely exploding. Now look at the second line, Performance Coatings Group, PCG. Also very strong. Sales up 8.4%, profits up a solid 20%. These two segments, the high-margin industrial businesses selling to professionals, this is the reinforced steel core of RPM's entire operation. This is the powerhouse.
Hold on a minute. You can't just breeze past that third line. The consumer group. This is where they sell their famous brands, Rust-Oleum, DAP, to all the do-it-yourselfers at the big box stores. And yeah, sure, on paper, sales were up 7.9%. But let's get our tools out and pry that number open, because this is where I see the first major crack in this foundation. The report says it clear as day. Organic sales, meaning the stuff they grew and sold themselves without buying other companies, were actually down 2.4%. They are selling less of their own core products than they did last year. That is a huge red flag. And this chart here just lays it all out perfectly. Let's really dissect that 7.9% sales growth in the consumer group. As you can see, a massive 9% of it came from acquisitions. They literally went out and bought their growth. Then you have to subtract that 2.4% organic decline. That's the part of their business that's actually shrinking. You add in a little 1.3% tailwind from foreign currency, and bingo, you get your shiny headline number. But the reality is, the core consumer business is getting weaker. They are papering over the cracks with revenue from companies they just bought. That is not a sustainable way to build anything. You can't just keep buying new rugs to cover up a rotting floor. Sooner or later, you're going to fall right through.
Okay, I hear you. But what you call papering over cracks, I call a strategic renovation. See, a smart property owner doesn't just sit there and watch things rot away. They invest, they upgrade, they reinforce the structure. The company is actively working to make itself better. And that brings us to profitability, because growth is one thing, but making money from that growth is what actually matters. RPM is making some smart, and some costly investments right now to build a stronger, more efficient company for the long haul. It creates some noise on the short-term numbers, I get that, but it's all part of the blueprint for long-term strength.
Noise? This looks more like a demolition zone with no sound barriers. Just look at the gap on this chart. The official, by-the-book GAAP reported earnings per share, 40 cents. But the number everyone is cheering about, the one plastered all over the headlines, the adjusted earnings of 57 cents, that is a 42% difference. It's massive. So the multi-billion-dollar question is simple. What exactly are they adjusting for? What real costs are they pulling out of the equation just to make the numbers look so much better? What's going on in the back rooms of this renovation?
Look, they're not hiding anything. It is right there in the financial statements for anyone who wants to read them. These adjustments add up to $32.2 million in pre-tax charges just for this quarter. And they're all tied to their MAP initiatives. That stands for Margin Achievement Plan. Think of it like a strategic demolition and rebuild. They are consolidating plants to make them more efficient, they're closing down older facilities, and they're optimizing their whole sales and admin structure. Yeah, it's expensive. These are real costs right now, but they're largely one-time costs designed to create a leaner, meaner, more profitable machine for decades to come. You have to spend money to build a stronger foundation. This is what good management teams do.
And where is that money coming from? Let's follow the money. It's coming from debt. A whole lot of debt. Just look at this chart. A year ago, February 2025, their total debt was sitting at $2.1 billion. Now, fast forward to today, it's ballooned to over $2.56 billion. That's an increase of nearly $500 million in just 12 months. So let's connect the dots. They're funding the acquisitions that are masking the weakness in the consumer group, and they're funding this massive restructuring by loading up the balance sheet with debt. That is a very, very heavy load for this structure to carry, especially in this interest rate environment. That $500 million in new debt costs a heck of a lot more in interest payments than it would have just a few years ago. This isn't just a renovation. It's like a leveraged buyout of their own future. A heavy load like that definitely requires experienced leadership to manage it. You can have the greatest blueprint in the world, but if you don't have the right foreman on the job site to execute it, it's all worthless, especially when you're juggling a major renovation and a growing pile of debt. And RPM just made some pretty significant changes. Specifically, in that consumer group we keep coming back to, the one with the organic growth problem, they're shuffling the leadership deck, trying to get that part of the project back on the right track. Yeah, they're shuffling, but they're shuffling insiders. Let's look at the new president of the consumer group, Don Harmeyer.
He's been with the company for 26 years. He was the CFO of that exact same group. And the new CFO, Tom Schweiger, he's an 18-year veteran of Rust-Oleum, their biggest consumer brand. Now look, these are experienced, qualified people, no question about it. But are they the right people to fix a problem they were already presiding over? The fundamental issue here is a lack of organic growth. They're losing ground. Promoting the finance guys from within doesn't exactly scream, we're focused on new product innovation or we've got a dynamic new marketing strategy. It feels like they're trying to fix a design flaw by just reshuffling the accountants. They're choosing stability when maybe what they really need is a disruptive force with a fresh pair of eyes. I'm skeptical this is enough to turn the tide.
That is a fair challenge. All right, you've heard the bull case, you've heard the bear case. We've inspected the dividend foundation. We've stress tested the growth engine's frame. We've gone through the financial plumbing, and we've met the new format. So now it is time to put it all together. It's time to unroll that final blueprint and deliver the official Iron Financial verdict on RPM International.
Okay, let's lay it all out on the table. The bull case, my case, is built on some undeniable strengths. First, you've got the dividend fortress. 52 years of increases backed by almost $4 billion in cash return to shareholders. It is the gold standard. Second, the industrial powerhouse segments, CPG and PCG, are just on fire with record growth and incredible margin expansion. That is the engine of this company. And third, management isn't just sitting on its hands. The MAP initiatives are a proactive, aggressive plan to build a more efficient machine. But the bear case is just as clear. That consumer segment is shrinking organically. That's a major red flag about the health of their core brands. And that weakness is being hidden, or at least masked, by a string of acquisitions paid for with borrowed money, which leads right to the next point. That rising debt load adds a huge amount of financial risk to the whole enterprise, especially with higher interest rates. And finally, the heavy reliance on adjusted profits tells me the true cost of this renovation is really significant. The core of the building might be solid steel, but the floorboards in the consumer wing are definitely starting to creak.
So after weighing all the evidence, we are officially issuing a verdict of cautious hold. And here's the logic behind that. The core of this company, the construction products and performance coatings groups, is rock solid. And that dividend really is a fortress that provides a strong floor for the stock price. We just don't see a compelling reason for current holders to sell a high-quality name like this. However, the risks are just too real for us to issue a buy rating today. That organic decline in the consumer business is a serious problem that has to be fixed, not just covered up with more acquisitions. And the rising mountain of debt they're using to fund this strategy is a major, major concern. So we're putting RPM on the official Iron Financial watch list. Before we could ever upgrade this to a buy, we need to see two very specific things. Proof that they can stop the bleeding and actually grow the consumer business organically, and a clear, credible plan to manage and start paying down that debt. For now, there's just too much construction dust in the air to see clearly. So, in the end, the final decision is yours. We've given you the blueprint, we've shown you RPM's incredible strengths, and its very real weaknesses. We've pointed out the reinforced steel core of the company, but we've also highlighted the potential cracks in the foundation and that heavy debt load sitting on top of the whole structure. Now, it's up to you to do your own homework and decide if this company is a solid addition for your portfolio. Thanks for tuning in to this explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.